Hi everyone. We're gonna start to explain and to go in details about wealth and of course about what is a fiduciary and role of fiduciary. So Wealthface is actually existing to make three cores super important to the clients: ease of use and ease to invest. Two is actually definitely the satisfaction of the client, and the third core is actually, which is the most important, is the information that the client have access to it. So we are going to discuss financial planning, invest young, and grow wealthy. So most of the people using financial planners, they still been confused between a broker and a financial planner, or an insurance company and a financial planner. Definitely, there's all these type of services are complementary one to each other, but there's a big difference. Not all of them, they take on consideration the objective and the goal of the clients, and many of them are very expensive, and not so many of them they advise the clients. So usually when we think about financial planning, we think about goal, objective, and of course our life dreams, because our goal to invest is to generate and grow our wealth in a way to generate more income or to build a certain capital or a gain that we can use for tomorrow or the day after. Financial planning are based on different objectives, as we have just mentioned. You can make a plan if you are a family that they have kids, for your kids to send them to the biggest Ivy League school, or you can plan for yourself and your partner a retirement early, or you can grow your income. And if you don't have your first house, there's always a first dream is to buy the first dream house. Why financial planning is important to achieve your financial objectives? Before I start talking about objectives, I would like to specify certain important things, especially lately, uh, and social media, and lately, especially specifically on the market here in GCC. Everyone opening a brokerage account, he think that he's a financial planner. Actually, he can become a daily trader. Yes, of course, and he can generate and he can earn some profits. But building a financial planning is focus on multiple basic steps and a processing. It's not easy. In the US, in the UK, Australia, and Canada, and many of the Commonwealth country, we spend more than 10 to 15 years working in this industry, and we're still looking forward to learn a new way, a new strategy, a new process to offer to our clients. So in the financial planning, there's the insurance as a basic, plus the portfolio management, the investment management, and the taxation. So you can decide to grow your income, and your time horizon, it's actually a short period of time of 3 years. This is mean when you decide to invest for only 3 years, you have to understand that to attain this type of objective, you are willing to take more risk because your plan or your exit objective is a short term. But when you plan for a long-term goals or a retirement objective, definitely the time horizon is different, and you can diversify your priority based on risk tolerance, objective, and strategies. And this is what we're going to discuss. So growing an income, it helps you to generate an passive income next to what you are doing. Example, we have here some people, they are actually doing a full-time job or entrepreneur, and they have decided to start working or and at very actually early age, and then they decide that it's enough. I would like to have another second income that help me to work less at the 40s and to keep my let's say income at the same level. You can also achieve goals on long term by owning different properties, and you can rent them, But to diversify, you need a financial planner to be able actually to put a plan and take action based on this plan. So let's discuss normal financial planning tools. On Wealthface website, as you can see here, will guide you. And we can take any type of scenario. We have put these tools for definitely the clients. He can use it. He can test it. But if he need any assistant, there's here on the down of the bottom, there's a chat box that you can chat with one of our advisor, or you can also definitely contact us or sending us an email where we can reply back. So this is a testing of any person that say we have here next to us Ahsan. Ahsan, he's I think 33 years old, and let's say he would like to retire at 65. He would like he expecting his life expectancy to live or to spend this much money for 20 years. He decide to start with a 25K and put, let's say, 1,400 per month. And he say to us that my desired income is 5K per month. So based on, or let's say 5K. So based on this information, you can definitely start making a plan, and the formula or the financial planning tools will tell you what is your objective here on the top, what is the time that it need to attain this objective, and then what is actually the amount that you need to save every month based on the risk or based on the profile that is customized based on your risk tolerance. So until now, hopefully everything is clear. Which type of advisor you have out there on the market that provide this type of solution? This is what we're gonna discuss, and then we're gonna show and compare what is the difference between one another. So definitely, I put all the type of advisor, bank, custodian, a broker, so you can, instead of comparing them and tell you this is good and this is bad, I don't want to do this type of exercise and say, oh, okay, this is the best way and this is the worst way. Actually, in each broker or custodian or banks, they have a good service. So at the bank is the best way to go and get a mortgage, and of course, definitely to have a checking account or a small saving account that you can access anytime you like. The insurance company is actually the basic. It's very important. I know here is not very familiar in the industry. It's very important to have a life insurance, especially when we want to protect our kids' future. Who are the advisors? So we were discussing the bank, the insurance company, the brokers, and this is what we would like to discuss. So there's many brokers on the market. There is a broker that they offer stocks, and there's a broker in the region that they offer CFD. And the CFD is a contract for difference where people are actually having not access to the market, but actually they are going to buy a leverage. And this is very risky and very dangerous that people, when they open a brokerage account with a CFD or a Forex company, and they believe that they can become wealthy or hold their assets in this type of brokerage, this is very risky and very dangerous. Uh, I would like to highlight this again and again and again because a broker, when he offers a CFD, that's mean he's not offering the underlying, which is the stocks or the bonds or the ETF or actually any type of commodities. So here you're taking not only the risk to keep your money in somewhere where it's not secure, but you're not taking the advantage to build a proper portfolio. And there's definitely the fiduciary advisor, which most of the advisor who sell mutual fund or any other type of investment calling themselves as a fiduciary advisor. But we have to be careful because a fiduciary is actually, he doesn't take any commission. He just charge a fixed fees. A fiduciary, he put his client interest first, and this is part of the satisfaction of the client. Of course, everyone he have his sales pitch, everyone is going to try to depreciate himself to sell his product, but this is why you don't want to be sold a product. You need a service. And this is something very, very important to do. So which type of problem you will be facing with this type of brokers? Very high fees, definitely conflict of interest because he want to advise you. At the same time, he want to make a commission and sell you this type of stocks or this type of funds. And the time that you consume by keeping your money in a brokerage account, and then every day there's an overrate fees that you don't see it. It's called overnight fees. And this is very important to pay attention. A fiduciary by law, by the SEC and FINRA, they have very specialized to define this type of solution or as definition of fiduciary, which is legally obligated to act in the client best interest. The advantage of working now digitally, and this is what Wealthface is trying to do, is to combine the two part, the part of the fiduciary, which there's always a hybrid solution, and there's always trying to serve the client to follow up on him, and at the same time accessible to everyone, where he can open an account in a few minutes, go through a full KYC account opening, and we will not charge him definitely other than the fixed fees. There's no commission, and there's unlimited access to your money anytime you want to do it. So until this, so you have an idea. There's difference between a broker and fiduciary. It's very important to get an advice, not just open an online investment account, but to talk to one of your advisor. If it's on Wealthface or working at a private bank, you should make a plan for your retirement. What you offer and what you receive is based on what you want and what you request. And this is why at Wealthface, we have decided to customize our portfolio and to rebalance those portfolio, which we're gonna discuss it in the future slides. So how brokers work and how fiduciary work, this is very important to highlight very quickly and to understand how the broker work. So you come, you open an account with the broker, doesn't matter the name of a brokerage, he's a broker dealer. They give you access to any type, let's say stocks, and then you heard on the market, I would like to, Apple is doing well, Tesla is doing great, Netflix is doing not so bad, and then you decide to pick some stocks and then you leave it in the portfolio. Then you suddenly understand with time that your portfolio, or he hit and he make a profit in the short term, or he just stays steady and nothing actually happened, which is very most of the time this is what happened. You lose time, and then you cannot uh,
بالله.
you lose time and you cannot actually invest in the right smart way. So if the market drop down, you actually lose money. And this is most of the time, especially when there is a pandemic, there is a crisis, you panic, you act emotionally, and you just, sorry to my language, kick yourself in the bottom, and then you lose all what you have invested in. And this is very dangerous. I made this mistake in my life because I was young, I was excited just to buy stocks. It's not bad to buy certain stocks, definitely, but you have to diversify. And this should not be just picking stocks, selling stocks just on daily basis, based on news or based on technical. It's not enough to build a retirement. So here, as you can see, the fiduciary, his role is to protect it you legally, one, make your interest first, manage on your behalf your amount of money in your portfolio, and this is what we're going to discuss very soon, and to be a certified or a company where train their team, and most of the team is certified financial planner, CFA, CIM, etc. So what we do at Wealthface is actually investing in ETF. Why we have decided ETF? For many reasons. First of all, an exchange trade fund is super liquid, means you can access to this type of products or this type of underlying, like any stocks. You can buy it and you can hold it. And there's many investors and high net worth investors are deciding now to move to ETF instead of just buying fixed income and stocks and commodity. So they can create a portfolio and they can pick certain stocks. There's many provider in the market like a BlackRock, a Vanguard that we're gonna discuss it, and then again decide, okay, I want an ETF of S&P 500. This is a passive way to invest. I don't need, example, any robo advisor. I go to interactive broker, I select 2 3 ETF, and I will sit on those ETF. And then in 5 6 years, I'm gonna maybe get a good return, which is true. But how come you know if those ETF are well diversified? It's very difficult because each ETF contains thousand and thousand of underlying, and you can have something that is actually appear different but is actually complementary. And if one ETF lose value on the market, the other ETF also lose. So there is no diversification and there is no uncorrelation. So you will lose money. So here the ETF is still the best way to invest, but you know you need actually to build a portfolio and a good, smart strategy that help you even if the market down or up and there's many cycles, you can always rebalance your portfolio in a smart way to keep growing your portfolio. The mutual funds, it's the old school of investing. It's similar to the ETF, but the difference is a closed-end fund. You cannot access anytime. The fees is much higher than the ETF because there's a money manager. He want to charge you 3 to 4% every year, plus the hurdle rate if he generate a certain return. And then what is not really good about a mutual fund, imagine there's an emergency, you need access to have access to this money. It's very difficult to sell this type of part, and it's not really flexible like an ETF that is traded like any stocks on the market. So let me show you. We're gonna actually show you here why ETF is better than. It's more liquid. You can solve it and buy it anytime. Are easy to access like any stocks. And then it's open end, which means each unit of ETF, it's actually triggered with a symbol or with a code, and then you can go to any broker to buy it. And there is have less taxes. So if you buy them, you pay less taxes, and definitely you pay less fees. This is type of portfolio many of you here actually have access to their portfolio, and I believe they're doing super good. Uh, this type of a growth portfolio that is number six, aggressive. Uh, I do have this portfolio personally in my investment. It's generating this year around 40%, which is above the market, even if the pandemic, since last 1st April 2020 until today, generate 40%. This portfolio has been created before a little bit or after a little bit the pandemic. This is why it doesn't reflect the 40%, reflect the 22. But I will show you the list of the portfolio at the end to have a look what was the performance of all the portfolio. So there's many provider. Again, BlackRock is a great platform that you can go get any type of ETF, buy it with a broker like Saxo Bank, Interactive Broker, and many others. But the problem here again that you're buying ETF without managing it, and this is what we're gonna discuss. Why fully passive is not the best way, and actively is not. If you're not really a portfolio manager, you're not able to do it. So how a robo advised like Wealthface have become really a leader in building portfolio management strategies. And when I say leader, believe me, all the clients they can understand how Wealthface in just a few months, how is it growing very quickly and very fast. People know us. We're just launching South Africa in the next June. We're going after that to Canada. So we're gonna cover 3 to 4 continents in the less than 3 years, which is excellent. There is a big demand on how you can make the client satisfied, and this is what we are trying to do. I'm going to show you here the type of investment. So why I have mentioned to you type of investment, because I can see here many of us, he like to trade. And this is why we going to offer a trading platform after the Ramadan. But definitely active trading is not active investing. Active trading is just buying and selling stocks for fun, for making return. Active investing is actually to build a portfolio, to follow up on a strategy and say, I would like to retire. I'm Bilal. I'm 39 years old. I would like to retire at 60 years old. I'm going to give my money to someone. He's a portfolio management who will actively manage my portfolio. I have $100,000. I give it to him, and he will be charging me 2 to 3% plus 10 to 20% hurdle rate. So at the end, after the fees, the passive investing way, it outperform, actually it is better because outperform after the fees the active investment management. So the passive investing, what is it? Is actually there's many robo advisors in the market, and here I would like to specify it. Many robo advisor in the market in the US, in Canada, in the UAE, in Singapore, and many others. What make a difference between an online investment platform and other online investment platform? Definitely, all of us we would like to do some marketing and expose ourselves and talk about ourselves and say we are the best. But this is not the purpose of our presentation today. Is actually to be careful when you go and open an account with a robo advise to exactly understand how this robo advise is actually behind the scene managing your portfolio, because you can put your money and buy yourself on ETF, it will cost you 0.2%, 0.3%. Why you will give it to a robo advice? You can open an account with interactive broker, select two, three ETF, and that's fine. That's enough, and you will generate 10% per year or 12% per year, which is excellent, better than the bank. But you have to go every time to check if it's going good and spend the trading fees. So definitely all the robo advice have a big advantage that they cover the trading fees on behalf of the client. But how I can say that no, my money, of course, if they are regulated by the US or the SEC, the money is secure $500,000, which like any broker dealer. But how I know that this money is managed properly, how I know that the way the strategy is built in is back tested, real back testing. So imagine I take a portfolio of 10 stocks or 10 ETF and I go back to 2015 and I said, okay, I'm starting investing from 2015 to 2021, and I say my portfolio is generating 20% per year. My dear, 20% per year in the last 4 years before the pandemic, it was something super normal. The S&P 500 was doing better than this. So you cannot say this is a portfolio management way because you did not include any crisis like 2014, 2012, 2008, the big crash. It was not included in your back testing. And this is very dangerous to give your money to a robo advice that he think that he's just because he's buying you an ETF, he know exactly what he's doing. This is super important to know. So a passive indexing or passive investing way, it's good, it's healthy, it's super systematic, but it's not the best way. The active management, definitely, if you have a great reputed portfolio management that is managing your money and getting you 20, 25% per year, this is excellent. But you need to have a million, 2 million, $3 million. So if you don't have this much of money and you have to pay at least 3 to 5% actually fees. So what is better is actually both of them are good, but the passive investing, even though is super ordinary, is still better than actively manage your money on a daily basis by a portfolio management, because the passively one by Morningstar, it's have shown in the pandemic that active management ways are not able to beat them because are very expensive. So at the end, the passive index or the passive investing strategies outperform the active investment strategy after fees. What Wealthface does, and this is super important, and I really highlight this because we are learning and we were keeping learning and we're going to keep learning to become not only the best on what we are doing, to make sure we are satisfying you. And if today you are 20 or 30 participant or tomorrow 100 or 200, and if we have just thousands of a client, our goal is to aim to have more and more and more hundred of thousands of clients, because the goal and the purpose is actually to make sure that we are able to share our knowledge, to educate investors, and to make sure that we are able and in the same way to grow. And to be able to grow and more money under management, that's mean you have to find a solution. So how the team in Wealthface and how the quant engineer and the financial engineer in Wealthface have become doing super well. I'm going to show you the portfolio details, but let me explain to you briefly, even if you're not a financial engineer or you're not a portfolio management or portfolio manager or you have expertise in portfolio management, doesn't matter. You need to know the minimum. The minimum is we are back testing your portfolio back 14 years. That's mean before the pandemic, before even the crash of 2008. So when the market move under there's any cycles in the market, short one, mid one, long one, there's a hit on the market, there's a drop, there's a huge growth suddenly, there's a lot of merger acquisition that is happening lately in certain sectors. This is actually taking in consideration. So because you have more data, because you are exposing yourself to a different situation in the market, to different cycle. So we have decided to take the model backed by a Nobel Prize research of building and optimize the return of the portfolio as a passive strategy, but taking in consideration this short cycle that happened, like the pandemic one, the one before, a crash, not crash, to reactively or actively and reactively rebalance your portfolio on a quarterly basis based on not just the previous allocation that we give it and offer it to you the first time you offer we offer the product, or you sign up and you register and open your account, but also on based on a target asset allocation, based on usage changing, and based definitely of any volatile that volatility can happen on the market. And this is why we include certain factors like low volatility factor, quality factor, to protect your capital if anything happens. So here I'm going to show you our portfolio lately just to have an idea. Definitely we're going to have a more investment session, more advanced. But since this one is the official one for Wealthface, I want you to show you the portfolio, the difference, and then build the trust to move forward to more educational portfolio management and more educational financial planning session. Let's take an example of someone low risk that he have 100% allocation in his fixed income. Someone who have 100% in fixed income definitely is better than a saving plan at the bank. And if you can, there's no stocks in this portfolio. It's very cautious the way he is investing. And if go since last rebalancing, now the market 1 month, 3 months, 6 months is still fresh, but you have to always look 1 year, 2 year, 3 year on average. And 1 year since the gross return after the fees and including the dividend, it was 6%. So if someone is a low risk, he put his money, he just doesn't want to take any risk, he's making 6%, is actually triple the inflation on the market. If someone is balanced, like it happened, and he want to diversify his portfolio between fixed income and stocks, 50% equity, 50% fixed income. This is a case of someone, he have two kids, he's 50 years old, uh, he want to generate a certain income, but he would like to make sure that he's not going to risk to lose any amount of money more than 10%. So he will invest in a safe way, balanced. He will generate definitely coupon and income from the dividend of the ETF plus from the FX income. And if you invested in this type of portfolio with Wealthface, let's say in 2008, $10,000, today you will be having around $30,000. And this actually without investing or saving on a monthly basis. So just keep 10K and you take it 30K. Imagine if you invest a 3K per month, okay, and you have invested 10K in the beginning, this money will be compounded, and we can see it now in the financial planning tools. It will be at least 130 to $150,000. So in the 5 years and 30 years, it will be like easily double. So the 30 will become 300 because there's a compounded return of the portfolio with time, which taking in consideration every month how you invest and how you compound them because you are consistent and because you persist to keep investing on a long term to attain your objective. Here is a semi-aggressive portfolio. So as you see as well, 1 year, 46%. from 1st of April 2020 to 1 April 2021. And even the year to date is still positive, and with just 3 months. And on 2 year average per year, you're generating 23%. So imagine you're putting 10K. The first year you're making 2,300. So the first year it's going to be 12,300. But the second year, there is a return actually on your initial plus on the gain capital if you keep it there. So the next year it will not be actually 12,300 plus 2,300. Definitely not. It will not be, that mean 1,400 or 1,000, 1,400, sorry, 14,600. It will be definitely more than that because it will be the return on the gain of capital as well. It will be around 15,000. So this is what you have to understand. And the super aggressive portfolio that we have, it generated 58% in 1 year. This is beyond the normal. No, because the S&P 500 did super well. And since we're taking in consideration the active management on a short cycle, but by protecting the capital on long term, Wealthface team, really big respect for you in Canada and the US, the one are managing the portfolio, are doing a great job, taking in consideration all the cycles in the market. You have satisfied the client from me. I'm really glad of this return. And I would like to just keep telling you that investing is a persistent, investing is a compound of return. Don't hesitate to save more in your portfolio. And the good news, a lot of many of us here is actually hearing us, and they are a client with Wealthface. We have promised them to offering them to be able to fund their account locally. The good news, we have received a green light and okay from Emirate MBD. They open the segregated account to receive money from our clients. And Monday morning, we're finalizing this with the regulator. So they will confirm it and we're going to move forward. And we're going to announce it definitely on social media and by email to all our clients to start funding their account locally. This is all for today. Please, you can start your question and feel free to ask anything.